On Business Incorporated today, Africa Development Bank opens ICT centers for women's skills acquisition. South Africa Purchasing Managers Index drops. And inflation accelerates in Somalia because of shortage of wheat. It's the midweek edition of Business Incorporated on Channels Television. You're welcome. I'm Ini John Mekwa. We begin as usual with trading activities in major equities, and markets are back after the holiday in Africa. NGX, which resumed from this two-day trading with more than 0.5 percentage gain as intraday paces towards the 50,000 level. Who knows? We might get that 50,000 at the close of trading today. For South Africa, the Jersey index traded in the opposite direction. It was down almost 1%, precisely 0.85%. Elsewhere on the continent, Egypt's EGX 30 gained 3.07% at intraday, while Nairobi Stock Exchange remains closed, the only market that's yet to resume on the continent. We leave the African continent now to the Middle East, where major equities were mostly negative at intraday. In the United Arab Emirates, both the Abu Dhabi and Dubai's indexes fell by 0.23% and 0.03% each. Still within that region, Saudi Arabia gained more than 0.5%, while the Qatari index was down 0.16%. We go to Europe now. Rising prices could force Europe's central bank to raise interest rates as soon as July. That's according to the executive board member in a new interview. The European Central Bank has so far hesitated to raise rates, fearing low growth across the currency bloc. Well, we have Stephen now, Birdsley, joining us now from Berlin to give us the details of that. Hello, Stephen. Good to have you. How fast are prices rising in Europe at this time?
Yeah, price hikes have been very pronounced in recent months. And what we've seen lately is in April, across the EU, 7.5% hike in prices compared to the previous April in 2021. That's considerable, and that's even up over this past March, we should say. So the trend continues to be upwards, though perhaps not as pronounced as we've seen in the US, where the dynamic is a bit different. Here in Europe, energy is really driving those cost hikes. Energy prices, we're talking about oil, we're talking about gas, even coal. They were already high before Russia's war in Ukraine, and now they've risen even faster. So that's really what's going on right now, is that we're seeing that translated to higher prices at supermarkets due to the transport costs for food, but of course at gas stations when people are filling up their vehicles.
And it looks like the ECB has been really slow to act.
Right. This has been the big question for a lot of observers. You have to remember that the ECB oversees the monetary policy for the 19 nations that use the euro. So there's not really a whole lot of agility in that, considering that you have both Germany there as well as Italy, and they're in two very different financial situations. The ECB is very concerned about growth across the EU. It is seen as fragile right now, and there are fears that if they act too quickly, that it could send growth rates negative for some countries, and that really then becomes a larger problem that could echo back from years past, where we've seen the whole euro project thrown into question because of weaker members. We have to remember that some nations, such as Italy, such as Spain, they have higher debt loads that makes borrowing very difficult for them. So once the borrowing conditions become tight, they're the first ones to feel it, and that really affects the whole eurozone. The ECB had penciled in a rate hike for 2023. Looking at the numbers and how they've trended recently, I think there's a concern that they need to act faster, especially to avoid what's known as a wage price spiral, and that is in which basically, employees looking at prices that they're having to pay demand higher wages. Businesses provide that, but then they have to raise their prices to afford those wages, and that continues on in a circle. And so Isabel Schnabel, she's the executive board member from this interview. She said that was something that they want to watch out for. They want to get ahead of that by possibly raising rates as soon as July. And so I think that's why we're seeing some urgency now. Nothing is decided yet, but this is a signal that there's going to be a bit more of an urgent turn, perhaps in the months ahead.
All right, certainly something to follow up. But how are the markets reacting to all of this?
Well, when we look at markets for the coming days, of course, what we're looking at right now is the Federal Reserve decision is big on the radar today, and that has ripple effect across markets around the world. So when we look at European markets, what we're seeing today is really a kind of muted reaction so far as they await that decision from the Federal Reserve. They're going to not really trade necessarily too much higher, too much lower. They're going to sort of take a wait and see. We know that banks, for example, are likely to profit from interest rate hikes. They're already trending upwards. HSBC already seeing some gains. But both the FTSE 100 and the DAX were starting out down. And I think that's going to probably be the trend for today until we have some sort of result from the Federal Reserve.
All right, Stephen, thank you so much for that update. We'll certainly get more about the FTSE there from Juliana. That's where we're going to next. Now, Juliana, good afternoon. Well, online fashion specialist Boohoo has recorded a drop in pre-tax profits in the year to February 28th. Well, needless to say, fashion may be taking a back seat in the face of all the emergencies that the world is facing at this time.
Well, definitely for some of us, Innie, but not for everyone, not for those influencers. But as you said, Boohoo have had a really tumultuous year to the end of February. Their pre-tax profits have fallen 94%. So their trading update, they showed profits of £7.4 million. But this time last year, they were reporting profits of £124 million. And I'm sure you'll remember, Innie, we were talking about the high street, the British high street, failing, lots of big names falling, and Boohoo was one of those fast fashion retailers that was swooping all of those popular names like Dorothy Perkins and Karen Millen up. So they've got 94 million customers around the world. But the problem is now that we've come out of lockdown, lots of consumer habits are changing. So one of the reasons why they have cited this fall in profits is because lots of their customers are returning. And I think returns is a key set of metric for retailers. And I've never done it, but apparently lots of people buy 5, 6, 7 different outfits. Of course, that goes down as a sale, but then they pick the one they want and they return 6 back. And that's really denting profits. Obviously, of course, another huge issue for them is shipping. Shipping is costing them a significant amount of money, as well as the supply chain disruption. So their shares fell 10% on the FTSE today, and investors are really concerned about what is to be for the future of the fast fashion sector, because the Boohoo bosses also cited that they're expecting even worse profits in the year ahead.
Wow, not a good thing to look forward to. And then there are conversations about possibility of energy firms getting a windfall tax. How serious is this?
Well, it's pretty serious. I think this story turned from a economic, financial story to a political storm, which is up for significant debate here in the UK, particularly on the last day of campaigning, which is today, ahead of tomorrow's local elections in the UK. Lots of people are saying that this election is a referendum on whether or not the British public still want populist leader Boris Johnson to stay in power. We'll give you all the updates on that on Friday. But one of the discussions that are taking place on British doorsteps is a windfall tax, which basically means the government will be taking a slice of the profits from companies that are benefiting the most from the cost of living crisis. And number one, of course, are the oil and gas firms, starting with BP, who yesterday posted exceptional results from their first quarter trading. Profits came in at £6.2 billion. Now, that's a lot of money, especially considering that to pay for the energy, British families have had to increase their bills by 54%. We have seen this windfall tax take place across certain countries in the EU, Italy, Bulgaria most notably. We know that the EU Commission are also are really keen on doing this. And the Prime Minister and the Chancellor Rishi Sunak have kind of shied away from this. I heard the Prime Minister speaking a couple of minutes ago, and he said he did not want to put a windfall tax on these firms because he fears that they will shy away from investment. And we know that foreign direct investment is on a decline in the UK because of Brexit. But BP have actually responded saying they would favour a windfall tax, or not favour it, they would be up for paying for a windfall tax, and this wouldn't deter them from investing in the UK. And so we'll just have to wait and see what happens. We know that it's certainly on the cards, and it is a big campaign talking point. So depending on what happens in these local election results tomorrow will, I presume, determine what the Conservative government do going forward.
Yeah, well, it seems windfall tax is becoming really popular because just a couple of weeks ago, President Biden also talked about it for the U.S. to handle the issue of energy. So, well, we'll see how it goes. And Stephen from Berlin actually tried to tell us a little bit about FTSE, how it's performing at intraday, but I know you have the details of how the market is.
I do have the details, thanks to my magic helper. The FTSE is actually in the red as investors anxiously await to hear what the interest rate is going to be set at by those in the US. And of course, Innie, you know that tomorrow we've got our own domestic decision. Everyone's on tenterhooks, and which I was supposed to be discussing this morning with Vladdy, those British retail numbers showing that inflation is really starting to hit not only at the checkout, but also in the stores. The FTSE All-Share is down 0.63%. The FTSE 100 down 2 at 0.56%. And the FTSE 250, the domestic market, down by triple-digit figures, 1.20%. In the currencies market, the British pound is currently trading up against the US dollar by 0.16%. Also trading up against the euro by 0.12% and trading up against the Japanese yen by 0.05% at intraday, Innie.
Yeah, thank you so much, Juliana. We have a busy day tomorrow. Figures and data from everywhere. We'll have a field conversation. Thank you so much. Enjoy the rest of your day.
You too. Thanks, Innie.
Let's move to Asia now, where shares in Asia Pacific were lower as investors look to head to the United States Federal Reserve's interest rate. That's where everybody's looking at, and it should be out later on today. Hong Kong's Hang Seng Index closed 1.1% lower at 20,869.52. Shares of Chinese tech firms listed in the city fell, with Tencent and Alibaba declining 3.05% and 3.74% respectively. The Hang Seng Tech Index dropped 3.29% to 4,264.91. Elsewhere, the Kospi in South Korea dipped 0.11% to close at 2,677.57, while the S&P AX 200 in Australia declined 0.16% on the day to 7,304.70. MCSI's Broadex Index of Asia Pacific shares outside Japan shed almost 0.5%. And now to the country where everybody's looking up now, the U.S. Stock futures inch higher in early morning trading as investors braced up for the Federal Reserve's big interest rate decision, where the central bank is expected to hike rates by 0.5 percentage point. Well, futures on the Dow Jones Industrial Average rose by 74 cents, S&P 500 climbed 0.26%, and Nasdaq 100 futures advanced 0.15%. We have our correspondent in Washington, Maria Bird, now to give us details.
The U.S. stock market ended modestly higher on Tuesday as the Dow Jones was up 0.2%, the S&P 500 up by 0.48%, and the heavy tech Nasdaq was up by 0.22%. This is the second day in a row of the week that the U.S. stock market has been on the rise. This is a much different tone than the end of April, where there were major sell-offs. It is unclear if this is related to the Federal Reserve's meeting coming up this week, and if many people are anticipating what the Federal Reserve will release during that meeting. It is definitely for sure that interest rates are also being watched as the Federal Reserve is expected to have a modest increase in those as well. The U.S. stock market has been through some turbulent times, but it's expected that it may level off despite the inflation concerns.
That's right. Concerns on inflation and now looking forward to what the Federal Reserve would say on interest rates. Well, we'll take a break now. When we come back, we'll dive into the African continent. We'll have lots of stories waiting for you there. Do join us. This is Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated here on Channels Television. Just before we go to our conversation for the day, the newest digital training centers of the African Development Bank Coding for Employment program are set aside for half of their initial training slot for women applicants. The Coding for Employment program, which equips African youth with the digital skills they need to contribute meaningfully to the global digital economy, is part of the foundational pipeline for girls and young women to pursue science and technology-related careers. Coding for the Employment held virtually and in-person ribbon-cutting ceremonies for 3 centers of excellence on the 8th of March. 2 of the centers are in Nigeria, at Covenant University in Ogun State and at Gombe State University, Gombe State. The 3rd Center of Excellence is situated on Kenya's University of Nairobi campus, and the ceremonies took place at the Covenant University and University of Nairobi. Bank representatives, Coding for Employment partners, and university staff were in attendance. Well, related to that, the 2 fastest growing companies in Africa are in Kenya. Kenya has a lot of shine on it now, and that's according to the ranking released by the Financial Times. Every company had to have its headquarters in an African country, and its revenue growth had to be organic. Well, we have joining us to talk about the impact or the expected impact of this is Steve Ogutu. Steve Ogutu is a communication and development expert. He joins us from Nairobi, the capital of Kenya. Hi, Steve. Good afternoon.
Hi, Amy. Good afternoon. It's a pleasure to be here with you.
Good to have you. So I'm sure you've seen that Financial Times ranking, which lists Africa's fastest growing companies in Kenya and Nigeria. What do you think are some of the contributing factors? We've seen a lot of startups in the past 1 year in these 2 countries and other African countries, though. You know, what do you think are the most attracting factors in these 2 countries?
Right, Amy, and that's a very good question. I think if you look at both Nigeria and Kenya, we have, I would say that we have an enabling environment, that's really, really key for businesses to thrive in terms of policies and tax regime. Though I say relative because we have made some progress, but there is still some work that needs to be done along that front. But also, if you look at in the case of Kenya, the ease of doing business here, it has really improved. In fact, according to the Trading Economics, in 2019, Kenya ranked number 56 globally when it comes to ease of doing business. Basically, looking at things like taxation regimes and things like that. Policies that enable private enterprises to thrive and things like that.
All right, so but, this is worth celebrating, and we do celebrate this. But how's this translating to individuals? How many of both Kenyans and Nigerians are feeling this impact of, being in the country where the fastest growing companies are located?
Right. I think there are two benefits. The benefits there are twofold as it is. Number one is there is the job creation. SME sector employs many people. Like in the context of Kenya, the SME sector is the number 1 source of employment for Kenyans here, and I believe it's the same case in Nigeria. But even beyond that, there is also the aspect of when these businesses are supported to thrive, Now they become sources of revenue for the government. And with that, government is able to meet their development needs and things like that.
All right, so you did mention that one of the attractions seems to be the ease of doing business. How can this explosion be sustained? Do we need to pay more attention to the ease of doing business, or are there other areas that should be looked at to sustain this growing startups and growth in corporates?
Right. I think now looking beyond Kenya and Nigeria, I think even other African countries, it is very important that governments focus on designing and implementing policies that attract private investment. That is very important. Also looking at developing capacity building programs that are targeting SMEs, in areas such as developing business plans, in areas such as just managing, financial and operational systems. Those are areas that really most SMEs struggle around. And if programs can be developed to address those gaps, I think that will be very important to ensure that enterprises thrive even at a startup level. Research indicate that most startups don't get to celebrate their second birthdays because of the reasons that I've given here.
All right, Steve, thank you so much. We do hope this will be implemented, and then this celebration will be sustained and it will be impactful, at the end of the day. Thank you so much, Steve Ogutu, Communication and Development Expert. So we move on now to South Africa, where the Purchasing Managers Index compiled by the Bureau for Economic Research dropped to 50.7 points, and it went from 60 points where it was a month earlier. And this is the biggest monthly decline and the lowest reading since July 2021, when deadly riots, looting, and arson erupted in the eastern KwaZulu-Natal province and disrupted supply chains, industrial output, and demand for manufactured goods. PMI appear more upbeat after short-term prospects, with the index tracking expected business conditions in 6 months' time, rising to 55.7 from 55.1. And in Somalia, shortage of Ukraine wheat is set to push Somalia inflation past 10%, as the Horn of Africa nation is battling its worst drought in decades. Somalia's inflation is expected to surge past 10% unless the country gets good rains over the next 2 months to help ease pressure on food prices after losing wheat supplies from Ukraine. The International Monetary Fund had warned of some countries which may become debt distress, and they include Somalia. That's our package for today. We'll do another one tomorrow. So join us then. I'm Ini John Mekwa.